Hey everyone, in today's video, I'm going to explain a common acronym that is used in finance, EBITDA. First, I'm going to give an overview of what EBITDA is and how to calculate it. Then, I'm going to talk about a few common uses for EBITDA in finance. And finally, I'm going to explain what EBITDA adjustments or add-backs are. So jumping into it, EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and is commonly used as an estimate for a company's unlevered free cash flow. The reason that EBITDA is commonly used as an estimate for a company's free cash flow is because the metric takes into account cash expenses such as cost of goods sold, SG&A, and other operating expenses, but is not impacted by non-cash expenses such as depreciation and amortization. The reason that it's an unlevered metric is because it's not impacted by the company's debt, given the metric does not take into account interest expense. Now there's two common ways to calculate EBITDA, as shown on the right-hand side of the page. First, there's a top-down approach, which you would start with revenue, subtract out cost of goods sold, SG&A, and other operating expenses to arrive at EBITDA. And second, there's a bottom-up approach, in which you start with net income, and you'll add back taxes, interest expense, depreciation, and amortization, and you'll arrive at the same number in either approach. Now let's take a look at a couple common uses for EBITDA in finance. First, EBITDA is commonly used to help arrive at a company's valuation. A popular method used to value a company, called the comparable company analysis, calculates a price range for a company based on a multiple of EBITDA. So for example, if company A has $10 of EBITDA, and we assume company A would sell for a 10 times multiple, the company would then be worth $100. Now, a second common use for EBITDA in finance is for a company to raise debt. Banks will typically base the amount of money they lend a company on a multiple of EBITDA. This multiple is commonly referred to as leverage and is calculated by the total amount of debt a company has divided by its EBITDA. So for example, if company A has $10 of EBITDA and the bank sets company A's maximum leverage at 3 times, the company would only be able to raise $30 of debt. Now these are just two common uses for EBITDA in finance, but as you may already know, EBITDA is used all the time within finance. Now that we understand what EBITDA is and know a few common uses for EBITDA in finance, let's take a look at EBITDA add-backs. EBITDA add-backs are adjustments made to EBITDA in an attempt to arrive at a normalized EBITDA figure for the company. Adjustments typically include one-time expenses and charges that the company does not expect to pay going forward. So to get a better understanding, let's look at the example below. You'll notice that in addition to paying cost of goods sold, SG&A, and other operating expenses, the company also had to pay restructuring charges, took a loss on a sale of assets, and also paid advisory fees. So to arrive at a normalized or adjusted EBITDA figure, we're going to add back those 3 charges that are one-time in nature, which include restructuring, loss on sale of assets, and advisory fees. Now these are just 3 common EBITDA add-backs you'll see. However, when analyzing a company, you'll come across many different EBITDA add-backs, and as a general rule, just remember to add back any expenses or adjustments that are one-time in nature. All right, hopefully you enjoyed the video and now have a better understanding of what EBITDA is. If there are any other topics in finance that you would like me to explain, please leave them in the comments below and I'll make a video on them. Look forward to talking to you guys again soon.